Welcome to our channel. If you want to invest in index funds, follow these step-by-step instructions to create a low-cost, diversified portfolio that matches market returns. Step 1. Learn why index funds are powerful investment vehicles. By tracking entire market indexes rather than trying to beat them, index funds deliver market returns with minimal costs and tax efficiency. Step 2. Decide whether to invest through a traditional brokerage account or retirement accounts. Tax-advantaged retirement accounts offer significant benefits for long-term index fund investing. Step 3. Select core index funds covering major asset classes, including domestic stocks, international stocks, and bonds. A 3-fund portfolio using total market indexes provides excellent diversification with simplicity. Step 4. Compare index funds from major providers, focusing on expense ratios and minimum investment requirements. The lowest cost options often come from large fund families with extensive index fund offerings. Step 5. Determine your appropriate asset allocation based on your investment timeline and risk tolerance. Generally, longer time horizons support higher stock allocations, while shorter horizons favor more bond exposure. Step 6. Automate your investments by setting up recurring contributions that purchase index fund shares regularly. Consistent investing over time smooths out market volatility through dollar-cost averaging. Step 7. Stay the course during market volatility and resist the urge to sell when markets decline. Index fund investing requires a long-term perspective and discipline to achieve the best results. Don't forget to like this video and subscribe to our channel.